Jewett Inc., a greeting card company that follows ASPE, had the following statements prepared as at December 31st, 2020. And we're given the comparative statement of financial position, and we're given the comparative income statement here. It's labeled the statement of financial position, but this is the income statement. And then we're given some additional information. Dividends on common shares in the amount of $6,000 were declared and paid during 2020. And depreciation expense is included in operating expenses, as is salaries and wages expense of $69,000. And equipment with a cost of $20,000 that was depreciated 70% was sold in 2020. And we're asked to prepare a statement of cash flows using the direct method and also the indirect method. And then we're asked if Jewett Inc. has any options on how to classify interest and dividends paid on the statement of cash flows. So let's get started here. So we're going to start with the direct method. So we know that under the direct method, we need, start here. We're going to have the direct method. So let's set up our cash flow statement here. So we're going to have Jewett Inc. statement of cash flows. And it's going to be for the year ended December 31st, 2020. Okay, so we know that under the direct method, we're going to be looking for the direct changes in cash flow. So we're still going to have our heading cash flow from operating activities. And our main headings here are normally, we're usually going to have cash received from customers, cash paid to suppliers, cash paid for taxes, cash paid. So we're going to have to look through all of our current assets and figure out what other headings we're going to need here. But let's get started with cash received from customers. So let's just do this on the side here. So let's take a look up here. So we're going to have cash received from customers. Let's start this right up at the top. So cash received from customers. So normally the way that we do this is we take sales revenue and then we're going to adjust it for a change in AR. So let's first start with sales revenue. And we can see that right here, $338,150. And then what happened with AR? So AR changed by, we started with 51,000. So we ended up 58,000 minus 51,000. So it increased. So let's put this in here, 58,000 minus 51,000 for AR. So it increased by 7,000. And this is, we're going to deduct an increase in AR. And the reason why is because the more AR that we grant, the less cash we're going to have, because AR is us allowing our customers to pay us later. And what we want is for them to pay us now. So we are going to make this into a negative. So we're going to deduct 7,000. So then our cash received from customers is going to be the sum of these two, which is going to be $331,150. So we can put this right into our statement of cash flows, because what we're trying to do here is just compute the numbers that we need to finish this direct method. So we've got this first one. So let's put that in. So it's 331,150. Okay. So what's next? And now we need to go cash paid. So that's, sorry, wrong line. Okay. So now we've got cash paid to suppliers. So let's take a look at what information we have in the question up here. So cash paid to suppliers. So we are going to take a look at, we're going to start with operating expenses. So what do we have for operating expenses? Well, we've got cost of goods sold. So this is a manufacturing company. It's a greeting card company. So we have operating expenses and cost of goods sold. And cost of goods sold are going to be part of what we pay to our suppliers as well. So let's start with cost of goods sold. And this number is, we can see right there, 165,000. And now now that we have cost of goods sold, we haven't seen a manufacturing company yet. We know that we're going to have inventory. So what's going to happen to our inventory? Let's take a look. So inventory here, it was 60,000 and now it's 40,000. So it decreased by 20,000. So if our inventory decreases, then that means that if our inventory decreases, then we are going to deduct it from the cost of goods sold because we've used less cash to buy inventory. So obviously when we buy inventory, we're using cash. So we've bought that much less inventory, so we can deduct it. So we're going to deduct a decrease in inventory. Let's make this a little bit bigger. Okay. And then next we're going to have purchases. So where are we going to find purchases? It's going to be the net of these two. So this is going to be purchases, and then we're going to take a look at accounts payable. So next we're going to look at accounts payable. So what's happening with our AP? So we've got AP here, and it went from 6,000 to 4,000. So AP actually increased, which is good. We want AP to increase. So an increase in accounts payable means that we use less cash. So we can deduct the increase in AP because we use that much less cash because we've got more terms now with our suppliers. So because we didn't use cash for this reduction in AP, then we're going to deduct it from the cash flow. Because it's a non-cash, it's a good thing. We haven't used cash to pay out AP, so we can deduct it from this cash outflow because we're looking at a cash outflow here, not a cash inflow, which can be a little bit confusing. This one up here is a cash inflow, which is why we're deducting the increase in AR. But here we're deducting an increase in AP because this is a cash outflow. So because our AP increased, we paid out 2,000 less cash. So we're going to deduct it from the cash outflow. And then this is going to be our cash paid to suppliers, which is going to be the sum of these two, 145 minus 2. So it's going to be 100, oh, wait, is it 2? Maybe I computed this number wrong. Let's take a look. What did we do here? So we said 6,000 accounts payable. Oh, it's 46,000, wrong numbers. So our accounts payable was 40,000 and now it's 46,000. So it's 6,000, there we go. So our cash paid to suppliers is 139,000 and we can take that right down onto our statement of cash flow at the bottom here. So we're going to say cash paid to suppliers is going to be minus 139,000, which is what we just computed up here. Now, what are other cash outflows? So let's take a minute. Let's highlight what information we've used in this question so we can make sure that we're tracking the information properly. So, okay, so we've got, what have we dealt with here? So we've dealt with accounts receivable and we dealt with cash. We dealt with sales revenue and we dealt with cost of goods sold and arguably gross margin. And we dealt with inventory. And we dealt with AP, accounts payable. Where's that? Here we go. Okay, so what other cash outflows do we have? So I can see that there's a cash outflow for operating expenses. We haven't dealt with that yet. So let's take a look down here. So we haven't actually dealt with operating expenses. So that's another cash outflow. So let's do cash paid for operating expenses. So let's start with operating expenses. And the operating expenses here are 120,000 on our income statement. So we're going to start with 120. Then we are going to, in the supplemental information that we were given, it said that we were given common shares, and then it says depreciation expense is included in operating expenses, as is salaries and wages expense. So we don't want we do not want depreciation expense to be part of our operating expense outflow because depreciation is a non-cash item. It's an accounting concept. There's no actual cash paid for depreciation expense. And salaries and wages, we're going to deal with separately on our cash flow statement because we're given, if you look at the reason why is because if we look at our balance sheet, our statement of financial position, we have a specific line called salaries and wages payable, so we can isolate that separately. So we need to remove two things from operating expenses. So we need to remove salaries and wages expense. That's salaries and wages. So let's take out the salaries and wages expense that we were given, which we were told it was $69,000 in that supplemental information. And we need to subtract depreciation because it can't go through our cash flow statement. It is a non-cash item, but we don't know how much depreciation expense is. So that's not great. We'll have to deal with that in a minute. And what other current assets do we have here? Well, we've got equipment. We'll have to deal with PP&E separately because that's required to be separate. Goodwill, total assets, prepaid rent is another one. We can lump that in here. So prepaid rent increase in prepaid rent. So prepaid rent went from 4,000 to 5,000. So prepaid rent increased by 1,000, which is a use of cash. It means that we must have paid extra cash for prepaid rent. So we're going to include that there. And then we're going to have cash paid for other operating expenses or operating expenses. It doesn't really matter. And it's going to be the sum of these. Now, obviously, we can't sum it up quite yet because we don't know what depreciation expense is. So we need to deal with that next so that we can complete this number. Okay, so let's figure out depreciation expense. So what we need to know is our accumulated depreciation. So depreciation expense. So we are going to start with, so depreciation expense goes through accumulated depreciation. Remember that we don't hit the actual capital asset account for depreciation expense. That's the whole point of accumulated depreciation. So the capital asset account just keeps the value of the asset, and then the accumulated depreciation is accumulating our depreciation expense each year. So in order to figure out the depreciation expense, we're going to need to take a look at that accumulated depreciation account. So our December 31st opening was 25,000. And then did we sell any equipment, or were there any transactions that would go through? Let's just take another look at this supplemental. It says equipment with a cost of $20,000 that was 70% depreciated was sold. Okay, so accumulated depreciation. So equipment sold would have removed the accumulated depreciation. It said it was 70% depreciated. So it's going to be 20,000 times 70%. That's the amount of accumulated amortization that we would have removed. And then we're going to have our accumulated depreciation, our December 31st closing. Let's see what that is. So we think it should be 25,000 plus, actually minus 14,000 because we would have removed this. So that would give us 11,000. And what was our closing accumulated amortization? It was 35,000. So the difference between 35,000 or 11,000 and 35,000 is going to give me 24,000. So that must be my depreciation expense. And the reason that I know that is because if I insert a line in here, this is basically what I'm solving for here. So if I insert a line here that says depreciation expense, which I probably should have left a blank spot for it. If I put 24,000 in here, and I fix this formula so it's picking up the sum, then it will equal, it's going to be this minus this plus this, actually plus this, yeah. Then I will get 35,000. My signs are just mixed up here. Yeah, because that was our opposing depreciation expense. There's our 35,000 closing. So my depreciation expense is going to be $24,000. So now that I know that number, I can take it up here. Now this is the direct method. So I'm not actually going to have depreciation expense on my statement of cash flows. We're going to use that number for our indirect method that we're going to prepare after. But right now I can put this 24,000 in here, and that is going to give me my cash paid for operating expenses, except for the fact that I need this to be negative because it's a cash outflow. So my cash paid for operating expenses is 28,000. So I can bring that down here. Okay. Next, let's see what we need to do. So let's take a look up at our statements and see what we've dealt with now. So let's make sure that we go through and highlight what we've dealt with. It's really important to track information in these questions because there's just so much information going on. So we dealt with prepaid rent, and we dealt with, what else did we deal with? Prepaid rent, and we dealt with operating expenses, which is down here. Operating expenses, so we've dealt with this. So what do we have left is the question. So, okay, so now we're going to go up here and say, okay, what's next? So now we need to deal with, we've got PP&E, which we know is not an operating cash outflow. So PP&E is going to be investing. So let's see if we have any other operating cash items. So we've got goodwill, which is not going to be cash. We've got income tax payable, which we do need to calculate for sure, income tax payable, and we've got salaries and wages payable. Considering that we just did operating expense and cash paid to suppliers, let's do salaries and wages payable first, and then we'll do income tax payable after that. So salaries and wages paid to employees. So we're gonna have, so here we're gonna start with our salaries and wages payable account, or salaries and wages expense. Because on our income statement, we also have salaries and wages because we were told in the supplemental information, depreciation expenses included in operating expenses, as is salaries and wages expense of $69,000. Then we're going to check what happened in our wages payable account. So the change in our wages payable, change in wages payable. So what happened there? Did it go up or down? So let's take a look. So what happened in wages payable? So wages payable, we've got, it was 4,000 and now it's 8,000. And so it increased 4,000 to 8,000. Just fix that formula. Okay. Let's see, I'm just going to expand this so you can see the formulas that I'm doing here. So salaries and wages payable, this is going to be 8,000 minus 4,000. Okay, so it increased by 4,000, which means that because it increased, it's not a use of cash. So we're looking at a cash outflow here. So we're actually going to add this back, or we're going to deduct it from the outflow. Again, that's where it gets confusing if you're adding or if you're deducting, because this is an increase in wages payable, which means we use less cash. And because we're looking at a cash outflow, then we are going to deduct it because it's that much less of a cash outflow. So then the cash paid to employees is going to be the sum of these two. And why did we have to adjust salaries and wages expense? Why couldn't we have just taken salaries and wages expense right off the income statement? Well, the reason for that is because salaries and wages expense has accruals in it. It might have an accrual for cutoff or what have you. But by comparing it with the payable account, because that's where the the accrual would be sitting on our statement of financial position, we can get a sense of what the cash impact is. And because the wages payable increased, it means we paid out that much less. So some of it is going to be paid out in the next period. We're only concerned with cash outflows from this period. So we've deducted that change. And now we've got our cash paid to employees of $65,000, which we can bring down into our cash flow statement down here. So we've got cash paid to employees of 65,000. And next we said we would do income taxes. So let's do that. Cash paid for income tax. Okay, so here we're going to start with our income tax expense on our income statement. And you'll notice that we always start with the income statement and then we're adjusting it for a payable. So here is our income tax expense, and you can see it right here, which is $4,125. Next, we're going to see what happened with our income tax payable. So income tax payable, what happened with that? Let's take a look up at our statement of financial position. So it was 6,000 and now is 4,000. So it went down by 2,000. So if our payable went down, that means we must have paid out something that we owed from a prior period. So we're going to add the decrease in accounts payable. So then our total cash paid, income taxes paid, is going to be the sum of these two, which is going to be 6,125. And we can bring this down into our statement here. Okay. So let's take a look up and see if we've covered off all of our operating items. And let's get out our highlighter and let's make sure that we're marking off what we've covered, what accounts we've covered. So we've got, what else have we covered here? So we've got prepaid rent. We still haven't dealt with equipment. We did deal with accumulated depreciation somewhat. We haven't dealt with goodwill. We dealt with income tax payable. We dealt with salaries and wages payable. And note that we're dealing with all the current assets. So equipment's not a current asset. That's why we haven't dealt with it, but prepaid rent is. So we've dealt with all the current assets. Of course, we're going to deal with cash at the end because we're going to make sure that our cash flow statement reconciles to the change in cash. That's why I haven't highlighted it. But we've dealt with all the current assets and we've dealt with all the current liabilities because short-term loans payable, even though it might be short-term, it's still a financing, or it's still a financing activity, sorry. So it's not going to be part of our operating items. That's why I haven't dealt with it there. Then if we look at our income statement, then we've dealt with operating income is just a subtotal. We've dealt with interest expense. Actually, we haven't dealt with interest expense because that's on the debt. We haven't dealt with the impairment loss on goodwill. That's not a current asset. We'll deal with that still. And we dealt with income tax expense. So that's about where we are. Let's take a look at the supplemental information and see what we've dealt with there. So we haven't dealt with the dividends on common shares. We dealt with this one, depreciation expense and the salaries and wages expense. And we did deal with this equipment with the cost that was sold during 2020. So we're in pretty good shape. We've used up all the information here and we know that we've completed our operating activities section because we've dealt with all the current assets and the current liabilities on our statement of financial position. So what we can do now is we can go down to our statement and we can run our subtotal for cash from operating activities. And then we'll move on to investing activities next, which is our next section. So we just got rid of my highlighter. So now we are going to say net cash provided by operating activities. The reason I'm saying provided by is because I see how high the cash from customers is. And so I'm pretty sure that we are going to have a positive here, but let's take a look. So we're going to have this amount plus this total here. And what's that going to give us? Oh, it didn't like that. Okay, let's do that properly. So we're going to have this plus these ones here. Okay, so we've got net cash provided by operating activities of 93,025. Let's just take a look at that. Okay, so we've got our 139, our 28,000, our 65,000. We've got our taxes. You know what we did miss is we missed the cash paid for interest. So cash paid for interest is going to be, let's see, so we do need to add a line there. And why is that? Let's take a look at this interest amount. Cash paid for interest. Where is interest expense? Is it a current asset? No, but we do have interest expense here on our statement of financial position, where on our income statement, sorry, where we've got 11,400. And so we are going to add this back in this section. So we're simply going to say add back cash paid for interest, which is going to be 11,400, which is going to, I'll just add this to this formula, which is going to result in, actually this is subtracting, sorry, this is a use of cash. So then our cash from operating activities is going to be 81,625. And we just took this amount straight off of the income statement because there was no balance sheet or statement of financial position account related to taxes payable. Okay, let's move on to our financing activities or investing activities. Cash flow from investing activities. And what are investing activities? So investing activities are going to relate to our non-current assets. And this is where we're going to see our PP&E. So let's take a look at what we've got there. So what we need to know here is what proceeds we got from PP&E and what purchases we had for PP&E. So let's see what we can get from the statement of financial position here. So we've got equipment. So we can see that there's a change in the equipment account. And what's going to go through the equipment account is any purchase of PP&E, because that's what changes this account. And what we're going to need to know is any proceeds from the sale are going to go through the accumulated depreciation account, because that's what we're using to clear out that account. So let's take a look here. Let's start with calculating the proceeds from PP&E. So let's figure out what we had. So we had some supplemental information here. Remember where it said equipment with a cost of $20,000 was sold. So we're going to have the cost of equipment sold. So we know we're going to have a $20,000 here. And our accumulated depreciation on that equipment was 70% of the 20,000. We had calculated that earlier, 14,000. So that means the net book value of equipment sold, was the net of this. So we would have had $6,000 net book value for that equipment sold. And we're told here that there was, let's see, equipment with a cost of 70,000 was sold. Okay, and then here on the income statement, you can see that there's a gain on the disposal of equipment. So we've got a gain on disposal, which we're picking up right from the income statement. We're not computing that. We're finding that number on the income statement. So we've got a $2,000 gain, and that means that our proceeds from PP&E must have been the net book value plus $2,000 to yield a gain. That means we must have received $8,000 in cash for that PP&E. So do you see how that happened? So we said, okay, what's the cost? We were told here that the equipment had a cost of $20,000 that was sold. And we're told that it had been 70% depreciated. So that's why we've taken off the accumulated depreciation to say, okay, what was that net book value? Because if we have the net book value and we can add the gain, then we can figure out how much cash we got for the equipment, which is this $8,000. And so we can take that right down to our statement here. So we're going to have proceeds from sale of PP&E, and we're going to have 8,000. Okay, so next we need to figure out what our purchases of PP&E were. So what about our purchases? So it doesn't mean we only got rid of PP&E. We could have purchased PP&E too. So let's see if we had any purchases. So what we're going to do is we're going to start with our equipment at December 31st, 2019. So our opening PP&E balance from the statement of financial position. And let's find that amount. So we had not the accumulated depreciation, but the actual equipment account. So we had 130,000. Okay. And then what was our balance at December 31st? Or PP&E, I should call it, at December 31st, 2020. It's going to be, so it's simply the change in that account is going to be 154,000. So what is the net increase? So the net increase is going to be, it's 154 minus 130. So we saw this account increase by $24,000. And remember, we sold equipment, so we'd also have to clear it out of the cost, which is the PP&E account. So the cost of the equipment sold. So we're pulling out that same number that we were given before, which was the $20,000. Remember, it says here in point 3 under the additional information, equipment with a cost of $20,000 was sold. So we're going to have the 20,000 here. So that means the cost of equipment purchased means that it went up by 24,000, but we deducted 20,000. So that means on a gross basis, we must have purchased $44,000 of equipment. So let's just take a look here. So what we did here is we basically are just comparing the statement of financial position account for PP&E and saying, okay, this account went up by 24, but we know that during the year, the company would have made a journal entry to decrease this account to reflect the fact that equipment was sold for 20. So that means that that means that this account would have only been $4,000 otherwise, but it's not, it's 24,000. So that means that then the cost of equipment purchase must have been 44,000. So let's bring that down into our statement of cash flows here. So then we're going to have purchases of PP&E, and we're going to have 44,000. Okay, so let's take a look here. So those are all of our investing activities, because if we take a look up at our statement of financial position, let's get out our highlighter and see what we've dealt with again here, just so we can track all this information. There's so much information on these questions, so it's really important that we track it. So now we've dealt with PP&E and we've dealt with accumulated depreciation. So we've dealt with our assets that relate to PP&E or to our investing activities. Now we're going to be dealing with loans and equity and goodwill. So in those cases, those amounts and we've dealt with this amount on the income statement, the gain on disposal. So those amounts are going to relate to our financing activity section. So let's turn to that now. And we'll run through the subtotal for the investing activity section. So let's do that. Now that we've done all that hard work to get all those numbers in there. So now we're going to say cash used by investing activities. So it's going to be the sum of these two, which is going to give us $36,000 of cash used by investing activities. And I should probably have put this over here, which means I'm going to have to fix my formula just so I have the right subtotal in the right place, but it's the same number, 36,000. Okay, so now our next section, as we know, is going to be cash from financing activities. So let's turn to that next. So we've got, let's see what we've got for financing activities. So interestingly enough, I had mentioned this goodwill account before. Now, what's interesting about goodwill is there is no cash associated with goodwill. So it means that this goodwill account is not going to show up on our cash flow statement. That's just a subtotal. And also on our income statement, I believe that there's an impairment of goodwill item. Yeah, that's not going to show up on here either. So that in the direct method, we're not going to account for goodwill at all. In the direct method, in the direct method, we won't account for goodwill at all because it's not cash. In the indirect method, we will need to reconcile it back to net income. But for the direct method, we completely ignore it because it's not cash. Okay, so now we need to deal with these loans. So we've got a short-term loan payable and a long-term loan payable. And we've also got equity that we need to deal with as well. So let's turn our attention to that to complete out our financing activity section. So let's run it here. So let's go, okay. So let's say, what were our principal payments on short-term loans? So we're going to be looking at short-term loans. We haven't been given any information on the loans themselves. So we've got, let's just see what the changes in the statement of financial position. So we had 10,000, now we have 8,000. So we must have paid back 2,000 of short-term loans payable. So let's go short-term loans payable. Or it should really say cash. Should say cash payments for short-term loans. So we had our December 31st, 2019 opening, which was, where's that account? 10,000. And then our December 31st, 2020, which is 8,000. So then the cash payments are just going to be the difference. So we had 8,000 and now it's 10,000, or it was 10,000 and now it's 8,000. Anyways, we've used $2,000 of cash. So we're just simply going to put that number down here. We're going to say principal payments on short-term loans. And why am I saying it's principal? Well, I'm saying it's principal because it's reducing down the balance on our statement. It's called short-term loans payable, and we don't accrue interest payable. So that would be reducing down the principal balance. Okay, now let's take a look at long-term notes payable. So let's go cash payments, long-term loans. We can basically copy the same format. And let's see what we've got here. Okay, so let's see what we've got for those balances. So we've got, so we had 69 and now we have 60. So that means that the cash payments must be 9,000. So we're going to have principal payments on long-term loans payable is going to be 9,000. Okay, and we still need to deal with equity. So we need to figure out what dividends have been paid. Normally we'd need to do a proof of retained earnings and possibly of dividends payable, but they were really kind to us in this question. You can see under additional information, it says dividends on common shares in the amount of $6,000 were declared and paid during 2020. So we know exactly what that number is. All we need to do is put it here. It's pretty sweet. So dividends paid, we're going to put minus 6,000. So that's all of our, so let's just take a look up here and see, let's just verify what we've dealt with here. Let's get out our handy highlighter. Okay, so now we've dealt with short-term loans payable, we've dealt with long-term loans payable, and we were given the numbers that we needed for equity. So we're in great shape. We've dealt with interest expense. Remember how we put this on as a cash expense. And then we've already dealt with income tax, and these are just subtotals here. So we've dealt with everything on both the statement of financial position and the income statement. So that means we've dealt with all the supplemental information, which we always want to double check. We dealt with this one. We have the dividends on common shares being paid. That's one of our financing activities. We've got the fact that depreciation expense was included in operating expenses. We took it out, and we dealt with salaries and wages payable as a separate line. Equipment with a cost of $20,000. We use that both to calculate depreciation expense and to figure out our purchases of PP&E. And we use the 70% depreciation to also prove out the proceeds from PP&E. So we've dealt with everything here. I think we're in great shape. Let's run through our subtotals in our statement, in our indirect statement. Get rid of my highlighter. And then we will see if we reconcile back to the change in cash. That is the test. Cash used by financing activities. So let's run a subtotal here. Okay, so we've got 17,000. So then our net change in cash is going to be, so we've got our operating activities, which are an inflow, and then we've got outflows from investing and financing. So our net change in cash is going to be 28,625, and it's actually an increase. Our net increase, let's change this, net increase in cash. Okay, and then we're going to have cash January 1st, 2020, and cash December 31st, 2020. And here is the moment of truth. So let's take the cash off our statement of financial position and see what we've got. So you know how we hadn't dealt with that line yet? So cash opening was 25,000 and then 53,625. So 25,000 and then 63,625. 23,625. So what's the change between these two things? Sorry, I put that in wrong. 53,625. Okay, so the change between this and this is, look at that, it proves out. We got it right. We've got the same change in cash as what proved out from our cash flow statement, and that's what you need to prove that you have the right answer. If the change in these two accounts, which I've calculated right here, does not reconcile to all the accounts that you have on your cash flow statement, then you've missed something or you've computed something incorrectly. Okay, so we finished our direct method. Good job. That was a fair amount of work, but it's satisfying. We know we did it right. Okay, so now let's take a look up at the question. And now it wants us to do it using the indirect method. Geez, that's a lot of work. Okay, actually the indirect method won't be too bad because we've done all the calculations here and we can use some of the same information. So let's change this. So this is the direct method. And what you can see here from the direct method is we don't have net income on our cash flow statement. There's no reference to net income. There's no reference to depreciation expense because it's purely cash flow. So we've got cash paid, cash coming in, and all different categories of that. What the indirect method does is it starts with net income and then it takes net income and reconciles it back to a cash basis. All the other sections on our statement of cash flow will be identical. It's the only difference between the direct method and the indirect method is for operating activities. Okay, so let's do the indirect method now. So what does the indirect method look like? Okay, well, we're still going to have our heading called cash flow from operating activities. Okay, and what we're going to start with next, though, is net income, and we did not have that on our direct method. So we're going to start with net income, which is not a number we've picked up before. So let's look up at our income statement and find that number. So we've got net income of $9,625. Okay, and then we're going to have adjustments to reconcile net income to net cash provided by operating activities. So basically we're taking net income and we're adjusting it from an accrual basis to a cash basis to reconcile it to net cash provided by operating activities. Okay, so we're going to put here, so one of the first things that we're going to add back is depreciation expense. And you didn't see this on our direct method either, because we didn't start with net income, so we didn't need to add back depreciation expense. So we're going to add back depreciation expense. And remember, we had actually calculated that. Luckily, we can use our same calculations. Remember, we needed to calculate depreciation expense right here, because we needed it to figure out the cash flows from operating activities. So our depreciation expense is $24,000. So we're going to add that back into our indirect method. Go down there. So we've got 24,000. So we're adding that back. It's a cash inflow from net income because it's a non-cash item. Next, we've got the impairment loss on goodwill. Again, we didn't pick this up in the direct method because it's non-cash. Remember how we said goodwill, there's no cash outflow for it? Well, because we've started with net income for the indirect method, now we need to make sure we add back things that aren't cash, whereas before we were just starting with cash, so we didn't have to do any sort of finagling with non-cash items. But here we need to add back that impairment loss. So let's look up at our income statement. We've got an impairment loss and it was $30,000. So let's add that back too. And that will be a positive inflow because of the fact that it's non-cash. So we're basically adding it back to net income because it would have been deducted from net income. Same thing with depreciation expense. We're adding it back because net income would have subtracted depreciation expense to get to the $9,625. Next, we're going to go through our working capital lines, and we're simply just going to list out the increase or decrease in each item. So let's see what we've got here. So accounts receivable. Let's just figure out what the change in accounts receivable was again. So we've got accounts receivable. So we had 51 to 58. So it increased. So 58,000 minus 51,000 is the increase. Let me just fix up this formula. Okay. So it increased by 7,000. So an increase in AR means that we used less cash, or we got less cash because we gave more people terms. So we don't want that, meaning it's a use of cash. So it's this is going to be a cash outflow. Then we've also got the gain on disposal of equipment. So the gain is a non-cash item, remember? So on our income statement, if we look way up here, we had the impairment loss on goodwill, and then we had the gain on the disposal of the equipment of 2,000. So the gain we're going to subtract because that added to our net income, but it's a non-cash item. So we're going to subtract that. Then we're going to have, so we've done in accounts receivable. Let's see what else we have in the asset section. So we've got accounts receivable. Next, we're going to need to do inventory and prepaid rent. So we're going to do inventory. So what happened with inventory? Did it go up or down? So inventory went from 60,000 to 40,000. So we use less cash for inventory. So we're going to add that back. It's good. Decrease inventory, because we used that much less cash because our inventory went down. So in theory, we sold $20,000 of goods out of inventory that we didn't use cash for. And then we're going to have prepaid rent. So prepaid rent, let's see what happened with that one. Prepaid rent actually increased by 1,000. I remember that from before. So an increase in prepaid rent is going to be a deduction, because we paid out cash then to increase our prepaid rent. We must have given out extra cash if our prepaid went up. So that's going to be a cash outflow. Then we're going to have accounts payable. What happened with that? So let's just double check up here on our statement of financial position. That should be all of our assets, all of our current assets anyway. Just like in the other section, any of our long-term assets are going to be part of our investing activities, so they're not going to be part of our operating activities. And we already said there's no differences there. So we've dealt with AR, inventory, prepaid rent, and equipment's not short-term. So we've dealt with everything. Then now we need to deal with accounts payable. So it went from 40 to 46. So 40,000 to 46,000. So accounts payable went up. So this is positive. Increase in accounts payable. So this is actually going to be a cash inflow. So that's going to be a positive 6,000. Then what other accounts do we have in our current liabilities? So next we've got salaries and wages payable. So that went up by 4,000. Increase in salaries payable. So this is also going to be a positive amount. So the more that we accrue, the less we have to pay out. So $4,000 increase in AP is going to be a cash inflow. And let's see what else we have up on our statement of financial position. So the last current asset that we have is, did we deal with income tax payable? I don't think we did. I think we skipped income tax payable. So let's pick up that one. So what happened with income tax payable? It went from 6,000 to 4,000. So it went down by 2,000. So we're going to have a decrease in income tax payable. So this is going to be a deduction because we're using that much less cash for income tax, which is good. So that is a cash outflow. So our net cash provided by operating activities is going to be, so let's just run a subtotal here actually. Let's just insert a line. Hang on. Okay, let's just run a subtotal so we can easily sum this. Subtotal is going to be this. So we're going to sum up all these things. Okay, so then our cash provided by operating activities is going to be this minus this, or this plus this actually. This is a positive. So we're going to have cash provided by operating activities of 81,625 using the indirect method. Let's take a look up at our direct method and see how that number compares. Oh, look, under the direct method, we had net cash provided by operating activities, totally different method, 81,625. So you have to get the same number, you're just going about it in a completely different way. So you can see that there's no difference there. And the remainder of the statement would be identical. Nothing about it would be different. So let's just put this in. 1 second. I'm just going to paste values in case any of my formulas get mixed up. So there you go. So then all the other sections would be the same. So of course the net increase in cash would be the same because these numbers are the same as above. So there's no changes to any other sections using the direct or indirect method other than operating activities. And so you can see how different the operating activities section is. Here we brought in net income using the indirect method, and then we reconciled through all the non-cash items we added back. And then we simply listed out the changes in the working capital account. So we're just looking for the current assets and current liability changes, and that's going to give us our net cash provided by operating activities. Whereas in the direct method, we went about it quite differently, and we specifically looked for the different categories of cash inflows and outflows from operating activities. But either way, we got to the same number. And our investing activity and financing activity sections are identical under both methods. Okay, so we've done A and B, and C simply asks, it says, Tuit Inc. have any options on how to classify interest and dividends paid on the statement of cash flows? And because Tuit follows ASPE, they do not have any choice as to how to classify interest or dividends in the statement of cash flows. Companies that adopt IFRS do have some choices. Under IFRS, interest paid and received and dividends paid and received can be recognized as operating cash flows, or it can be recognized as a financing outflow, while interest and dividends received can be recognized as an investing inflow. A choice is permitted for dividends paid, a financing outflow as a return to equity holders, or as an operating outflow as a measure of the ability of operations to cover returns to shareholders. So IFRS allows policy choices for interest paid and received and dividends paid and received, but ASPE does not. It requires interest, it requires dividends paid to be a financing activity, and it requires interest paid to be an operating activity. So that is the completion of this question. Thanks for bearing with me throughout this long question, but I do hope it gave you a good overview of the direct versus the indirect method of creating cash flow statements.